Well, good morning, everyone, possibly good afternoon, depending on where you're at. My name is Shawn Bragdon. I'm a managing partner here at BGA Insurance. And today we're going to be going over a great topic, I think. It's whole life versus index universal life. I'm not going to lie to you. I'm going over a lot of numbers today, and permanent life insurance, it's complicated. So if this is not something that you're doing on a regular basis, that's what we're here for. We have 16 people in sales, brokers, directors. They're all experts on permanent life insurance. So if you need some help in educating yourself or your clients on any of the material we go over with today, give us a call. And we'll go ahead and start right in. Everyone's going to be on mute. We'll open this thing up for questions at the end of the presentation. You can also type in a question, and hopefully we can get to most of your questions. So I first did a case study, you might call it a white paper, back in 2015, where I compared the very best whole life products in the marketplace to the best index UL products in the marketplace. And the first case study I did was just on a male age 45. And this male age 45, his primary goal is to contribute $30,000 a year into a cash value life insurance policy designed for retirement. He's very interested in tax-free retirement income. After reviewing all the products out in the marketplace, MassMutual had the best whole life product, and Minnesota Life had the best index UL product. And right here, we have a side-by-side comparison, and this is just some software we have. So if you need to get, a side-by-side comparison report like this, we can create this for any of your clients or prospects. So we have a male age 45. He's contributing $30,000 a year for 20 years. We had a MassMutual product back in 2015 that had a dividend of 7.1. And we used a Minnesota Life Index UL product growing at 7%. We saw for the maximum income we could pull out of both of these products starting at age 65, and that's a lifetime income. The MassMutual product had just over $54,000 a year, whereas our Index UL at 7% was $130,000. We're talking about 138% more retirement income on an Index UL that's being credited at a slightly lower rate. The other thing you're going to notice here is the death benefit on the Index UL is much lower than the death benefit on the whole life. And that's, in this case, a big advantage for the Index UL because we're able to go with a lower minimum non-MEC death benefit, which will reduce the mortality costs in the policy and allow us to build better cash values. And so if you put too much money in a policy and you create a modified endowment contract, then all the gains would be taxable, and that would defeat the purpose of what this client is looking to accomplish, and that is tax-free retirement income. As I mentioned, this income continues all the way out to age 100. And here at the bottom, we've tallied up our totals that over our lifetime on our Index UL, we've actually pulled out over 4.5 million tax-free. And the very best whole life product in the marketplace in 2015, you were pulled out just over 1.9 million. So you pulled out substantially more money out of the Index UL at roughly the same crediting rate. A lot of times I like to show reports that summarize the internal rates of return or just summarize the cash value. This is just another nice report that breaks down a 20-year summary. Here's our death benefit and our cash value of our whole life. Here's our 20-year summary on our Index UL. Again, the Index UL is winning in both cash value and death benefit in year 20. And here's the internal rate of return report. This is the pre-tax equivalent rates of return required to compete with an Index UL at 7% or a whole life product at 7.1. And so our 20-year internal rate of return on the whole life is 5.3. The Index UL is 9.25. I mean, that's a compelling asset class in my opinion. And so what this IRR means is what rate of return do you need to get on, say, a traditional retirement account in order to build to the same cash value in year 20? And you're going to have to make, 9.25% return on a taxable investment to compete with this index UL growing tax-free at 7. And then here's some additional IRRs through age 90. And what's compelling with the index UL is the internal rate of return of 12.63 is actually greater than our crediting rate of 7%. The IRR on the whole life is also greater than our crediting rate of 7.1. And you might ask, how does that work? How does that happen? Well, both these products have loan provisions that allow you to get an arbitrage between the loan charge and the crediting rate of the policy. So in essence, you can get make a return on the money you pulled out and spent. This is just another summary page showing IRRs at age 90 and on cash value and death benefits. So these are really compelling numbers. And as I mentioned, when you pull money out of an index UL policy, most of the best products in the marketplace have either a participating loan or a variable loan. And this is kind of the secret sauce on an index UL on pulling cash out of the policy tax-free, that if you decide to use a participating loan, the insurance company might charge you 5%, but they're also going to credit you whatever you achieved in your index strategy that year. So if you make an 8% rate of return on your index strategy and they're charging you 5 for that loan, you're actually making a positive 3% return on the money you pulled out and spent. First time I heard about this, I was stunned. I said, that can't be true. That sounds too good to be true, but it is true. And so most of these products either have a participating loan, which is a loan charge that's fixed and will not change. And then other products have a variable loan, which is a moving loan charge. It's based on the Moody's Corporate Bond Yield Average, which is super low right now. Right now, variable loan charges are in the range of like 3.5%. So if your return is north of 3.5%, you can get a positive arbitrage. Participating whole life products, some of them also give you the ability of getting an arbitrage like that. So if they have a variable loan charge of 3.5 or 4%, and you're getting a dividend north of that, you can get an arbitrage on a whole life policy as well. This is a nice report showing you the historical arbitrage on a variable loan. On an index UL product over the last 10 years, it's been 3.5%, and over the last 20 years, it's been 2.61%. That's a pretty compelling story. Again, you pulled this money out and spent it, yet you're getting a positive rate of return on it. And with the new rules that have, AG 49 rules that have kicked into our industry, as of today, if you run an index UL illustration pulling out income via a participating loan, the maximum arbitrage you can show is just 50 basis points. So in my opinion, you're pretty much going to outperform that when historically you're looking at an arbitrage north of 2.5%. Often when I speak to insurance agents that are big fans of whole life, they might make comments like this, the actual return on an index UL is going to be a lot lower than what's illustrated, and that's due to all the zeros you're going to get over the years. And by contrast, a whole life product is always going to pay a return every single year. I'm not aware of any whole life company that hasn't paid a dividend on their participating whole life products in a year, so that you're always going to get a return on a whole life product. But if you dive in a little deeper and you look and see how the market actually performs, this is a snapshot of the S&P 500, the annual returns from 1980 through March of this year, and the S&P 500 since 1980 is actually up 78% of the time. So 78% of the time you're going to get a positive rate of return, and that means you're going to get a positive rate of return on your index UL product. And 23 out of these 42 years, the return was north of 10%. And so basically you have a 70% probability of a 10% return or better on the S&P 500. And so that bodes well for an index UL that's, capturing those gains on the S&P 500, where you're going to be limited on your whole life product. You're only going to get the return based on what that insurance company is going to pay on the dividend, and you're not going to get a double-digit dividend today or anytime in the near future. Another way, here's a nice chart. Which of these numbers are more attractive? Are the high numbers good or the low numbers good? What do these represent? Well, what these represent is the probability of getting a zero return on an index UL product if you pay an annual premium versus a monthly premium. So if you pay an annual premium, dump it all into the S&P 500, your odds of getting a zero return in the first 10 years is 92.3%. By contrast, if you simply pay monthly, or most carriers offer dollar cost averaging, where your client can cut one annualized check, and they will move that money from the fixed account into the index strategies each month. So you're still able to get the advantage of paying monthly premiums. And basically, you're able to reduce your client's risk of getting a zero return by 65% merely by telling your client to pay a monthly premium or dollar cost average. And the zero number here, that's the percentage of financial advisors that are actually explaining this to their clients. Most advisors I speak to did not know that this was actually a fact, that if you dollar cost average or pay monthly, you dramatically reduce your odds of getting a zero. This next page is a report done by one of an insurance carrier that showed that if you not only paid a monthly premium or dollar cost average, but then diversified between 3 different index strategies that they had available, after year 5, your odds of getting a zero return were 0, and that's basically, they back tested this historically, and it just never occurred with the 3 index strategies that they had. You would always get a positive rate of return after year 5 if you paid monthly and diversified between multiple index strategies. So if you design your index UL correctly, your odds of getting a zero go down dramatically with the best products out there in the marketplace. So if you recall the original comparison of the whole life versus the index UL, I assumed a 7% return on the index UL. Well, what happens if you get a lower rate of return, which is certainly possible? Here is a comparison where we have our whole life product at 7.1. We have our index UL growing at 4.6, 5, and 6%. So what this is telling me is your index UL only needs to get a 4.6% return to beat the very best whole life product in the industry. So at 4.6%, you're pulling out $55,973 versus our whole life $54,803, and they had a 7.1 dividend. If we increase our return to 5%, we're able to bump up our retirement income to $67,000 and some change. So that's almost a 23% increase in retirement income. Excuse me. And if we increase our crediting rate to 6%, our income is 62% more. Historically, these products have actually gotten returns between 7 and 8% historically. Those are the returns you're getting. And yet at 6%, you're going to provide your client 62% more retirement income than the best whole life product in the industry. This is just a continuation of that report. We showed that income going all the way out to age 100. You got 3.1 million of total income at 6%. Again, the best whole life product, you're at 1.9 of total retirement income. So how can an index UL growing at a paltry return of 4.6% beat a whole life product growing at 7.1? It seems like the math doesn't work. How is that possible? Well, it really has to do with all the fees, loads, and charges that are baked into that whole life product. There's a lot of fees in there. And unfortunately, we don't even know what those fees and charges are, because you can't print out a report on a whole life product that breaks down all the fees, loads, and charges. It's a proprietary black box by all these large mutual insurance companies. They will not share this information with agents or the public. By contrast, if you want to know all the fees, loads, and charges on the exact illustration that you designed for your client, you can print out a report on virtually any index UL product in the marketplace, and it'll show you the annual charges built into that product year by year. So it's very transparent. And which do you want? You want a mutual fund that averages a 10% annual return but has a 5% management fee? Or would you like a mutual fund that averages 10% return and has a 1.25% management fee? Historically, if you design an index UL product properly, the long-term costs are about 1.25% to 1.5%. And we have some material that can show that to you. So if you recall, everything that we went over was going back to 2015 when I first did this white paper on whole life versus IUL. So I've actually tracked the performance of the MassMutual whole life product and the Minnesota Life IUL product that I use in this comparison over the last 6 years. So how do we actually do over these 6 years? Well, the average return for the Minnesota Life Index UL was 7.72. The average return for the MassMutual whole life product was 6.65. So, and this is just showing a growth of $100,000 in the IUL versus the whole life product. And, MassMutual's dividend yield has gone down since 2015. So you were over-promising and under-delivering if you were presenting a MassMutual whole life product in 2015. By contrast, if you were presenting a Minnesota Life Index UL, you under-promised and over-delivered. And I kind of like that story. And this is a chart showing the historical dividends of the top whole life companies out in the marketplace. You got Guardian, MassMutual, New York Life, Northwestern Mutual, Penn Mutual. Look at this, back in 1988, the dividends were double digit. I mean, MassMutual had 11.35% dividend. And heck, I mean, I'd love to see a dividend on a product like that today. But interest rates have been coming down, since the 1980s, and all the whole life products almost annually have been reducing their dividends almost every single year. And so back to 2021, we're at 5.65 for Guardian, 6% for MassMutual, New York Life 5.8, Northwestern Mutual 5, and Penn Mutual 5.75. By contrast, the returns on index ULs have been spectacular over the last 6 years and since these products have come out to the marketplace. So these products have been around for about 15, 16 years. Some of the companies will actually publish on their website the return that you achieved on every premium payment your client could have made into the index UL product. Most insurance carriers, they buy the index options for the index strategies in their product once a month. So if your client buys a policy, you put it in force on June 1st, that money typically doesn't actually go into the index strategy until, say, June 15th. And so you can pretty easily track the rates of return every single premium payment could have achieved. And that's what this is a report on, showing the actual returns of every premium payment you could have made into a Minnesota Life Index UL product since 2007. And the actual return was 8.2. So if you recall, the very first proposal we went over was assuming the Minnesota Life product did 7%, and we had 138% more retirement income than the MassMutual Whole Life. God forbid we actually got 8.2. I mean, that's off the charts. So that's a compelling story. Again, these are not historical look backs. These are the actual returns that have been achieved on this Minnesota Life product. And they publish that on their website. It's there right now. So now we're moving on to the same male age 45, but this guy's goal is different. His goal is he wants $1 million of permanent death benefit protection to protect his family. He's looking for the lowest cost product that he can find. And so again, I scoured the marketplace back in 2015, looking for the very best whole life products, the very best index UL products for this type of death benefit design. And again, MassMutual came up on top on a death benefit sale. The premium for the MassMutual $1 million death benefit, we're just talking about a level pay, $18,860 a year. And so what I did to compare that premium to an index UL product is I actually call this a combination plan, where I take that same whole life premium and I buy 2 index UL products. One index UL product designed purely for death benefit protection, guaranteed death benefit protection. And the second index UL is going to be designed purely for accumulation purposes. And so here's our comparison. So here's our whole life product, again with a 7.1% dividend. We have an $18,860 annual premium, and we have a guaranteed $1 million death benefit, but based on the non-guaranteed dividends, that death benefit will grow. And over here on the right, I again have a combination plan. I have a North American index UL growing at 7%. We're putting $10,754 in premium, and this has the minimum non-MEC death benefit. So this is designed for accumulation purposes. And then we have a protective life index UL product growing at 5.76. We're paying just over $8,100 a year, and that will guarantee our $1 million death benefit. So we have the same guaranteed death benefit, and then we also have a second policy designed for accumulation. And this column right here is the combination of these 2 policies. Same premium as the whole life, $18,860. I just added up the values. And if we look at age 65, we have almost $1.7 million of death benefit versus the whole life, you're just under $1.4 million. Our cash surrender value is almost $700,000 versus $586. So again, we win, and our illustrative rate, our combined illustrative rate is 6.47 versus the MassMutual at 7.1. Oh, the other thing that I think is compelling with this combination plan is this second policy, the second index UL policy. The client could stop making premium payments, let's say at age 65, turn off that increasing death benefit and use this policy for retirement income, and he still has this $1 million guaranteed death benefit on the second policy. If you tried to do the same thing on the MassMutual product, the moment you stop making premium payments and start pulling cash out of the policy, all the guarantees on this whole life product disappear. You will not see any guaranteed columns on an in-force illustration on a MassMutual whole life policy the moment you pull money out of the policy. All the guarantees on the report completely disappear. Whereas with this combination plan, you still got $1 million guaranteed death benefit. And if that's really all the client wanted was $1 million of guaranteed death benefit, you could have just said, hey, you can pay $8,106 a year. You get that $1 million death benefit versus that whole life $18,860. And again, that's the best whole life product in the industry in 2015. This is just a 20-year summary. Here's our index UL. We have more cash, more death benefit compared to our whole life. And let's now go out a little bit farther. I mean, when are you likely to die? You're going to probably, most people are dying somewhere between age 80 and 90. And so if we go to age 90 with our combination index UL plan, we have 4.8 million in death benefit versus our whole life product at 3.5. I don't ever recall any beneficiaries saying, hey, we have too much death benefit. I mean, they're happy to get that extra $1.3 million in tax-free death benefit. I'm a big fan of adding these internal rate of return reports to any permanent life insurance illustration. You know, a lot of people just don't realize what a great asset class permanent life insurance is. And so you're looking at some substantial internal rates of return. And so here's our internal rate of return at age 90 on our Index UL combination plan, 9.55%. And again, what taxable investment could you contribute $18,860 a year to every year for the next 46 years and have it be worth more than 4.8 million? Well, you have to get a return north of 9.5%. Good asset class. Just a graphical representation. Here's our, in green is our combination Index UL plan on death benefit, and here's our MassMutual whole life. We're winning across the board. Well, what about the guarantees in a whole life product? A lot of agents that are fans of whole life will talk about guaranteed cash values and, of course, guaranteed death benefits. So let's take a look at those types of comparisons. So again, we still have this combination plan. We have a North American IUL and a Protective Life IUL. This particular North American IUL actually had a guaranteed 3%, I would call it a true-up return, that if your client didn't get at least a 3% rate of return over a 7-year period, the insurance company would true up the policy and give you at least that 3% rate of return. The Protective Life Index UL just had a straight zero floor. So the composite return on the guaranteed values on these Index ULs was 1.71. And then here are the guaranteed values of our MassMutual whole life product. So let's look at death benefit. If you recall, this 45-year-old's goal was $1 million of death benefit. This is a death benefit sale. So in year 20, we have $1.4 million of guaranteed death benefit on our Index UL, which is substantially better than our $1 million guaranteed death benefit on our MassMutual whole life. The MassMutual guaranteed cash value is better, but that's not why this guy bought this policy. He bought the policy for death benefit. And if we go down to the years that this client is likely to die between age 80 and 90, you have substantially more guaranteed death benefit for the same premium on this combination Index UL plan. At age 90, it's $1.4 million versus $1 million. So let's take a closer look at our guaranteed cash values on our MassMutual whole life policy. You know, you're interested in guaranteed cash values? Well, are you really? I mean, is your client going to be excited about a guaranteed negative rate of return on their money? That's the internal rate of return on the guaranteed cash value on the MassMutual whole life product. You're never making a positive rate of return. So if your client is excited about a negative rate of return, I mean, they'd be much better off buying some municipal bonds. They're at least going to get a 2% guaranteed rate of return. So I'm not excited about guaranteed cash value because you're not making any return on your money. It's negative across the board all years. So now we're back to 2020, and I decided to do the same kind of white paper, same kind of comparison of the very best whole life products and Index UL products in the marketplace on the same male age 45. And so I did this in October of 2020, and I came up with the top 4 whole life products for male age 45 designed for supplement retirement income. Now, New York Life had the best product with a 6.1% dividend. MassMutual was at 6.4, but I was still able to actually pull out more income out of the New York Life product, $51,513. The MassMutual was just over $44,000. You got Ohio National at $43 and Guardian at $35,000 of tax-free income. Ohio National recently demutualized, and they actually reduced their dividend yield down to 4%. So that just happened fairly recently, so this would certainly be inaccurate. But New York Life is the winner today. So we did the same here. Okay, here are the same IRRs, good IRRs on the whole life through year 20 on the death benefit and the cash value. So this clearly shows New York Life's the winner. A summary of the values. Here's our cumulative after-tax cash flow or tax-free cash flow from the New York Life. All the other carriers are less. You got the best IRRs on the death benefit as well. So I then compared, the number one product, which was New York Life, to an Alliance Index UL product. And I ran the Alliance IUL at 6.4, 5.8, 5.2, and 4.8%, just to give us a nice comparison. And this is a nice summary chart of those various crediting rates on an Alliance Index UL. And what's our income? So at 6.4, you're going to pull out $111,000. If you recall, the New York Life was pulling out just a little north of $51,000. So you're pulling out 116% more retirement income at 6.4. You're going to pull out 80% more retirement income if your product does 5.8. You're going to pull out 36% more income at 5.2 and 11% more income at 4.8. 4.8 is ultra conservative. As far as I know, there's never been a 5-year period where an index UL averaged that low of a return, and yet it beat the very best whole life product in the industry at 4.8. This is just a summary of our total retirement income on the whole life. 1.8 million. At 4.8, you get almost 2 million. At 5.2, it's 2.4, 5.8, 3.2, and 6.4, you're pulling out 3.8 million. And so why give up your upside by going with a whole life product when you have tremendous upside on an index UL designed for supplement retirement? This is a nice piece that Allianz puts out every year. Every year they look at the returns that all the policies that they've issued have achieved. And they've been issuing index UL policies since 2006. They've issued over 30,000 policies. And this annual review showed that the average return of all 30,000 policies, 6.98%. So again, these are actual returns, not historical look-back returns. And our most aggressive illustration that we ran on the Alliance was 6.4, yet since 2006, all their policies have averaged 6.98. So again, you're going to under-promise and over-deliver with an index UL product if you design it correctly. So here's the top 4 whole life products in 2020 for a death benefit sale. Same male, age 45. He wants to just get that $1 million of death benefit for the lowest price possible. Penn Mutual came up number 1 in 2020 on a whole life product. Our premium is $16,730. MassMutual was number 2. Guardian was number 3, and New York Life came up in number 4. Again, the death benefit's increasing. At age 90, you got about 2.8 million on the Penn Mutual whole life product. Good internal rates of return. And let's compare that to a combination index UL product. So again, Penn Mutual is number 1 in 2020 for a death benefit sale for a male age 45. We did that combination plan where we took the same MassMutual whole life premium and bought 2 index ULs. In this example, we bought an Allianz index UL designed for supplement retirement and an AIG index UL with a guaranteed $1 million death benefit. So we get to year 20, we have the same story. We have more death benefit, 1.4 versus 1.3. We have more cash value in year 20. But let's look at, the years your client's likely to die, somewhere between age 80 and 90. Our combination index UL plan at age 90 has 4.4 million in death benefit versus 2.8 million on the very best whole life product in the industry in 2020 for a male age 45. Summary of our cash values and death benefits on the index UL versus the whole life. Got better numbers on there. Good internal rates of return, very attractive asset classes. Another summary, comparison of our death benefit on our combination index UL plan in green. We win all the time. And so why do a lot of agents still sell whole life? Well, based on what I've seen in my 31 years in the industry, it has to do with commissions, career contracts that are available in the marketplace, training, and a lack of education. So here's one of the things that a lot of people don't realize. That male age 45, that $30,000 annual premium going into a whole life policy, a typical agent with New York Life is going to make $36,000 in commissions over a 10-year period. If you sold that same Index UL product with Alliance over a 10-year time frame, that agent's going to make about $15,400. So the compensation on whole life products over 10 years are 2 to 3 times more than an Index UL. I mean, that's just the way they are. There's a lot of fees, loads, and charges baked into those whole life products. And if they're paying twice the commission on that whole life product, that money has to come from someplace. Who pays for this? Well, in my opinion, the client's paying for that, where you're going to be able to get a lot more bang for your buck with an Index UL versus the whole life product. The big mutual companies, the Northwestern Mutual Life, New York Life, MassMutual, they have what's known as career contracts. Often they're hiring young people out of college, they're training them, they get great training, and they're often not allowed to sell an Index UL. They have to sell MassMutual's products only, and they only are allowed to sell away or sell a different carrier's product if the mutual company declines the case or it's so highly rated that the insurance agent can't place the case, and then they can sell away or broker out to another carrier. But typically these career contracts, if they do sell away or sell a different carrier product, the general agency takes such a large percentage of the compensation on an outside business activity that it's just not worth it for the agent to sell something outside of his insurance company career contract. Typically, the young agents that are coming into these career contracts are just trained to sell whole life term insurance and maybe a little bit of variable life insurance. Often they're trained, to get money under management, not so much on the life insurance side. But they do get great sales training, and so even if their product line is inferior, they're still able to make a lot of sales, often with the help of mentors that are available with many of these career agencies and the way they're set up. So, what are the reasons to buy a whole life product? Well, one of the reasons are carrier ratings. Typically, you're looking at the big participating whole life carriers. They have the best ratings in the industry. They really do. They got great brand name recognition. Maybe your client is buying a couple of policies and they just want product diversification. Maybe the client's going to buy an Index UL and a whole life product. And you're going to bump into some clients that just say, hey, I want a whole life product because that's what my dad bought, and give it to them. We don't care what product your clients buy through BGA Insurance. We just hope you process that business through us. And even buying a whole life product is vastly superior than what a lot of people do in this country. And that is, a lot of people don't buy life insurance, or they certainly don't buy the amount of life insurance they really need to protect their family. So even buying a whole life product, even though I've kind of bashed whole life throughout this whole presentation, is a heck of a lot better than not buying any life insurance and going uninsured. This is just a snapshot of the ratings of the top whole life carriers. You got New York Life, Northwestern Mutual, MassMutual, Guardian. They all have an A++ from AM Best. That's the #1 rating out there. 100 Comdex for these two carriers. So they're a very highly rated company. And if that's what your client is asking for, give it to them. Nothing wrong with that. By comparison, you look at some of the good Index UL carriers, and pretty much all the carriers offer Index UL, but you're not going to get that #1 rating from AM Best with any of these carriers. #2 is going to be about as good as you're going to get. So, the MassMutuals and the New York Lives of the world, they have great ratings. They really do. So that is about all I have for this presentation. We tossed a lot out there for you. Hopefully we can open this up for some questions. Let's see if
Hey, Shawn.
Yes.
So, yeah, this is Matt. So you touched on this, but I was hoping you'd spend a little time. You have a saying that I think works very well. And one of the questions asked in the chat comments is, hey, why are you showing two separate IULs, one for death benefit, one for accumulation, two separate companies. He was a little confused. And oftentimes somebody will say, hey, but look at all the cash in a whole life. Look at all the death benefit in a whole life. And you have a saying, could you spend a little bit of time on, you're either buying life insurance for one of two reasons. Can
Yes.
you get into that a little bit?
Yeah. So yeah, in my opinion, that there's two ways to design a permanent life insurance product. If you're designing it for death benefit protection, you want the smallest premium that you can pay for that $1 million of death benefit protection. If you're designing a permanent life insurance policy for accumulation purposes, you want to pack in as much money as you can into the smallest death benefit possible to build cash value. So in those, and that's two different index UL products, two different types of designs, where with a whole life product, it's kind of that in-between product. You're going to not get the best performance when for death benefit. You're going to overpay, or you're going to underperform on a whole life product. You're going to overpay for the death benefit. You're going to underperform on the cash value. And it's just kind of that in-between product. Good question, Matt.
All right. Guarantees, yeah, that's one of the bigger attractions to a whole life. Oh, but look, this is guaranteed, and you would hit on this as well. And one of our colleagues in the office, Ken Williams, said something I thought was interesting. Yeah, they will always say, hey, but look at the guarantees, look at the guarantees. And as you had mentioned, as soon as you pull a dollar out of that, those guarantees are gone. But Ken had said, hey, okay, so how long have these whole life carriers been in existence? They'll say, well, since the Civil War in some cases. And how long have they paid the dividend? Well, they've never missed one since the history of the company. So why would you be making a decision based on a probability, historical probability of zero?
Great comment, Matt. Yeah, I'm not aware of any whole life carrier that has ever reverted to, the guarantees on a whole life product. So it's kind of immaterial. Why talk about something that has never happened in over 100 years? And we're talking, 2 world wars, the Great Depression, the 2000, or the meltdown in 2008. I mean, all these things that have occurred, and yet these companies are still around. When the financial meltdown in 2008, there wasn't a single insurance company that went belly up, where you saw over 300 banks go belly up. So you're talking zombie apocalypse when you're looking at the guaranteed values of a permanent life insurance product, because those guaranteed values assume the day after you took out the policy, the insurance company went belly up, they increased mortality costs 300%, and you never got, an attractive rate of return on your cash values. So it's never happened. So why talk about it? You really need to talk about the projected dividends on a whole life policy and your projected crediting rate on an index UL policy. Those are what's more likely to occur. Let's see, any other questions?
Hey, Shawn, we had a question in the chat box asking, and on whole life with the history of dividends every year, why were you showing a negative growth?
Because I just plugged in the guaranteed cash values in that software report. And if you calculate the cash value compared to the premiums that you've contributed to the policy, your cash value never exceeds premiums paid. End of story. So the guaranteed cash values on a typical whole life policy, you're not making any return on your money. Even though you have a 7.1% dividend on your current assumption side on your whole life policy that is building cash, the guaranteed columns, negative return. Some of the products you might get maybe a 50 basis point return by the time you get to year 20. But for the most part, you're not making any considerable return based on guarantees.
Hey, Shawn, there's a pretty good question that just came up in the chat box from Jonathan. How different would this presentation look from the IUL standpoint if you geared it to New York approved products?
That's a good question. I mean, New York has a lot less product to look at. But there's still, there's still some good index UL products approved in New York. One that comes to mind is National Life. National Life has a great accumulation index UL product, and in my opinion, it'll beat any New York approved whole life product in the industry for an accumulation sale. No question. And my recommendation on clients in New York is, why don't you get a trust set up in New Jersey or Pennsylvania and have the policy owned there, so you have a much broader selection of products to choose. I don't understand New York. The products are not as attractive as the rest of the country. All right. If there's no other questions, I want to thank everyone for joining us. Again, we went through a lot of material, and this stuff is complicated.
One last one. I'm sorry. Ken
Okay.
Williams threw one in here. Comment on the overloan characteristics of an IUL and potential devastating consequences of overloaning on a whole life.
Good question. So basically, virtually every index UL product out there that I'm aware of, certainly the ones that are designed for accumulation purposes, have a feature that's often referred to as an overloan endorsement feature, where your client has, owned this policy for a lot of years. They've pulled out a ton of money via policy loans out of the index UL policy, and the policy is on the verge of lapsing. And if that policy lapses, your client's going to get a huge 1099 from the insurance carrier. Well, all these products turn that policy, in essence, to a reduced paid up policy that's guaranteed not to lapse. And that's, usually the parameters of that feature is your client has to be, 70 or older when he enacts this process. Policy has to be enforced for at least 15 years. And your client has taken out so many loans out of the policy that is on the verge of lapsing. And this is, something that is not automatic. The, client and or agent would have to contact the insurance company and say, hey, I would like to enact this overloan endorsement feature, but they should be forewarned. They should be getting lapse notices, grace period notices, things like that. When you pull money out of a whole life policy, as I mentioned earlier, all the guarantees disappear, but often, you'll see these things that if it does lapse, you have a massive taxable event, because when you're receiving dividends on a whole life policy, it's actually reducing your cost basis in the policy. So you might have a client that, hey, I put, $300,000 into this policy, and he's thinking if he just lets the policy lapse, because he didn't have, a huge gain on it or something, he's not going to have a taxable event, but he might find out that his cost basis in the policy is dramatically less than that. And as far as the overloan endorsement features, to tell you the truth, I'm not 100% certain if the whole life products have that type of feature built into their products or not. That's something I guess I'll have to check on, but I do know they exist on index UL products.
Hey, Shawn, we got two more questions for you that I'm seeing pop up. One, few people asked of how are they going to access this recording?
This will be posted on our website.
And then another one is, can you explain why when splitting the two policies, you would do two IULs rather than a GUL for the DB policy and IUL for the cash accumulation policy?
I certainly could have done that, but when I did the analysis on, the very best guaranteed ULs versus index ULs that also provided the same death benefit guarantee and had cash value, I preferred to go with the index UL that had the death benefit guarantee and the cash value. I think in my comparison in 2015, I could have gone with a guaranteed UL that would have been a little bit cheaper than a protective life index UL, but not substantially so. And I said, why give up the cash value if I just have to pay a few more bucks? But you could certainly do that. And in fact, there are products out there, if you're FINRA registered, they're variable life products that'll provide a guaranteed death benefit to age 121. So you just don't need to go with index UL. That's another option out there. So did that answer the question? I think.
Seems like it.
All right. If there's no other questions, again, if you need anything that we went over today, don't hesitate to give us a call. There's 16 people in sales here. They are all experts on life insurance. If you want to copy this presentation, shoot me an email. I can get it out to you. And as I mentioned earlier, we will be posting this webinar on our website, and you can take a look at it at your leisure. Thanks again for taking the time, and we hope to be working with you soon.